Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CHINA LESSO interim report. CHINA LESSO Group Holdings Limited offers a diverse range of businesses and services across various sectors. Some of the key areas include manufacturing of piping and building materials, pipeline system solutions for municipal engineering, water supply, drainage, power, and heating, water-saving irrigation and aquaculture systems for rural and agricultural use industry and commerce services, including mining, chemicals, food, oil and gas, and water supply, firefighting pipelines and gas pipes, building materials manufacturing, including aluminum profiles, machinery, monocrystalline silicon, fertilizer, and chemical products, property development and investment, e-commerce platform and logistics services, first-mile international freight and last-mile fulfillment, mosaic tile production, power generation, technical service, and internet data service, hosting sports events. The stock price of CHINA LESSO Holdings has seen a significant increase of over 30% in the past year due to several contributing factors. A key driver was the company's decision to increase its dividend, making it more attractive to shareholders. Positive analyst ratings from institutions like CD also played a role, as did the company's focus on its core business and competencies. Additionally, investors were drawn to CHINA LESSO's expected profit growth and perceived undervaluation, which suggested that the stock was a bargain. Furthermore, industry trends such as price increases in related sectors may have signaled a more favorable operating environment for the company. Overall, these factors combined to drive up investor confidence and push the stock price higher. The primary drivers of revenue growth and decline can be summarized as follows. Revenue growth is primarily driven by increased production capacity, nationwide sales network, long-term strategic partnerships, diversification of products, product innovation, automation, introduction of new technologies, expansion of global footprint, favorable market conditions, smart manufacturing, and enhanced brand influence. On the other hand, revenue decline is mainly attributed to decreases in revenue from building materials and home improvement. Others, category, industry adjustment cycle. Increase in initial operating expenses related to overseas markets, decrease in financing costs due to optimized debt structure, decline in PVC products revenue, non-PVC products revenue. Supply chain service platform business, new energy business, bank interest income from other receivables, government grants and subsidies, and investment income. Net income and profit margins. A shift in industry dynamics. The company's net income experienced a decline of 8%. Primarily due to the industry adjustment cycle, adoption of cost-plus pricing method, increased operating and development expenses, and reduced financing costs. This decrease is reflected in the net income figure of RMB 10,856 million, a 3.2% drop from previous levels. Profit margins also underwent changes, with gross profit margin increasing slightly to 28.2%, while EBITDA margin decreased to 19.8%. Notably, the overall gross profit margin declined by 3.2%. The net profit margin remained steady at 7.5%. These fluctuations in net income and profit margins can be attributed to the company's response to industry dynamics, including changes in pricing strategies and operating expenses. As the company adapts to these shifts, its financial performance is likely to continue evolving. The company's operating cash flow is inconsistent, with both positive and negative results reported in different periods. While there are instances where the company generates positive operating cash flow, such as on pages 42, 48, 50, 63, and 65, it also experiences negative operating cash flow, particularly during the 6 months ended June 2025, pages 33 and 34. The presence of both positive and negative results suggests that the company's ability to generate operating cash flow is not stable. The company's debt level and interest expenses have undergone significant changes over the past period. Initially, total debts decreased to RMB 19,048 million on page 14. However, this trend was short-lived as total borrowings increased by 57% from RMB 11,850,772 to RMB 18,593,198 on page 69. On the other hand, interest expenses have consistently decreased across various reports. The largest decrease of 22.7% was reported on page 4, while a 23% decrease was noted on page 49. These changes indicate that the company's debt level has increased significantly, but its interest expenses have been decreasing over time. Regional performance overview. The financial summary reveals that Southern China was the standout performer, accounting for 46.3% of the group's total revenue in 2025. This region saw an increase in revenue from 2024 to 2025. In contrast, outside China performed poorly in terms of revenue share, decreasing from 55.3% to 53.7%. However, it is worth noting that this region still showed an increase in revenue from 2024 to 2025. Business unit performance. Among the group's business units, plastic piping systems were a notable success. On the other hand, building materials and home improvement, as well as others, underperformed. Management is optimistic about the company's outlook, citing a stable development trend in China's plastic piping system industry. To maintain this momentum, they are focusing on core business growth and strengthening competitiveness. A steady growth strategy will help mitigate global uncertainties, while leveraging smart manufacturing will drive innovation and expand revenue. The company is also investing in new developments to create long-term synergies and broaden sales channels, positioning itself for future success. The company's financial summary reveals that it has indeed paid dividends in the past. Specifically, for the year ended 2024, the company distributed a final dividend of $0.20 per share to its shareholders. This indicates that the company prioritizes returning value to its investors through dividend payments. Concerns over inventory buildup and supply chain disruption. The financial summary highlights several areas of concern regarding inventory buildup and supply chain disruption. Notably, manufacturing and trading inventory increased by 25.6% from December 2024 to June 2025, indicating potential inventory buildup. Additionally, intersegment revenue declined significantly, suggesting supply chain disruptions. Furthermore, the write-back/write-down of inventories to net realizable value is negative, raising concerns about inventory buildup. The photovoltaic industry's overcapacity and supply-demand imbalance also indicate potential supply chain disruption. These issues warrant close attention to mitigate any adverse effects on business operations. That concludes the financial summary for China LESSO. Feel free to comment below, and I will be happy to answer them when possible.